Welcome to RBC's Markets in Motion podcast, recorded April 14th, 2025. I'm Lori Calvasina, head of U.S. equity strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. We've been busy seeing clients, reading, and writing over the past week. The three biggest things you need to know. First, the stock market is still experiencing a growth scare in our view. Second, the process of resetting earnings expectations has begun, and we run through key themes from the early reporters and companies that have presented at conferences since the Rose Garden tariffs. Third, we run through our latest thoughts on the growth trade. If you'd like to hear more, here's another 5 minutes. Let's start with takeaway number one. Where are we, and have we been in the drawdown? In our view, the stock market is still experiencing a growth scare. Last Tuesday at the close, the S&P 500 was 18.9% below peak, basically touching the bottom of our second tier of fear, which is a 14 to 20% drawdown similar to those of 2010, 2011, 2015-16, and 2018. Those drawdowns were all driven by concerns about a recession or crisis that didn't materialize. 2018 in particular is a good analogy in our minds. We had frothy positioning and valuation to start the year, fueled by optimism on tax. Then we got a trade war and concerns about policy error from the Fed. That drawdown totaled 20% in the end. If a recession is baked into markets today, there is more downside for the S&P 500 to 4,200, 4,500 in our opinion. That kind of move would be in line with the median and average drawdowns from peak of 27% and 32% since the 1930s. For now, though, the stock market does appear to be trying to stabilize in growth scare territory. What were we talking to clients about last week? We found that we kept highlighting how some milestones that we look for in major market bottoms have been achieved. AAII net bulls are already at crisis lows. The University of Michigan Consumer Sentiment Index is as bad as 2022. And small cap PEs hit 12.6 times last Tuesday at the close, in line with the lows of September 2022 and October 2023, when we saw pretty big drawdowns in the broader market. That 12.6 times level is also in the range of what we typically see in a recession, where the PE multiple tends to bottom out into the 11 to 13 times range. All that being said, other indicators have not hit critical extremes yet. CFTC weekly U.S. equity futures positioning is still in the early innings of falling. NFIB sentiment for small businesses, meanwhile, has weakened but has a lot more room to fall before hitting past lows. And S&P 500 forward PEs are still well above average. Moving on to takeaway number two. The process of resetting earnings expectations has begun, and we have some early indications of what key themes in reporting season might be based on our transcript reading. The reset of earnings expectations needs to be done so investors can have faith in valuations. It's another necessary milestone that needs to be achieved for stocks to put in a durable bottom. Here are some of the stats we've been tracking on earnings. The bottom-up consensus for the S&P 500 EPS in 2025 has now fallen to 267, still above our own estimate of 258, but the good news is it's finally started to move lower. Downward guidance has picked up, but isn't seeing the same spike yet as early last year, and we could see some companies suspend guidance. The rate of upward EPS estimate revisions has also now fallen to 38% on the 4-week average. It had previously been stuck a little above 40%. In a non-crisis period, we look for this stat to fall to 30%, and in a crisis year, we look for this to fall to the 10 to 20% range. Improvement on the rate of change on this metric is often a sign the performance bottom is in. On earnings results, we actually think they do matter. Our stats show that companies beating consensus on earnings so far in this reporting season are outperforming in terms of immediate stock price reaction, while those that are missing consensus on earnings are underperforming. We've described reporting season as potentially like a box of chocolates. We really don't know what we're going to get. We have been reading earnings call transcripts for the early reporters, along with conference transcripts for companies across the S&P 500 and Russell 3000 that have come in since the Rose Garden announcement. Some of the key themes so far. On the overall outlook in macro, big banks have highlighted a wait-and-see attitude among their customers, hesitancy and caution, particularly in regards to longer-term commitments, and the idea that smaller businesses and smaller corporates may be more likely to be impacted by tariffs. On recession, views varied a bit, but did highlight the growing risk of this outcome. Some banks also emphasize that it will likely take time for the reset in trade policy to play out and price into markets. Consumers generally, not just by the banks, but by most companies, were still described as healthy, and there were some differing views on the low end. The weight of the moment we find ourselves in within financial market history also seemed to loom large in what we've read. A number of companies have found a reason to refer to a significant crisis from the past, including 9/11, the GFC, and COVID. Most of their references emphasize their company's strengths and/or ability to manage through, while some of the banks took the time to express confidence in the Fed as well. Tariffs were obviously the policy issue in focus, with some companies highlighting how they'd already been moving out of China, had already diversified their supply chains, and were already sourcing a lot locally, or simply had low exposure. Some others also expressed optimism about negotiations. One industrial company noted, however, that they had not found scale manufacturing capabilities to satisfy their needs in North America. Some companies were baking tariffs into guidance, while others were not. Some noted they are not in a position to provide meaningful guidance until the policy settles out, and that it will take time to understand the full implications. Overall, we did feel like the specificity from companies has improved, and that's really been needed. Some companies alluded to a pull forward of demand and inventory pre-builds, but not all. Most noted they would look at pricing to mitigate impacts. Overall, what we've read so far leaves us of the opinion that recession is not a foregone conclusion, but also that U.S. equities aren't out of the woods yet. We'll wrap up quickly with takeaway number 3, our thoughts on the growth trade. It's not clear-cut right now. Growth has started to outperform value again within large cap, even before the announcement about the exemptions on Friday night and Saturday. And we've also been seeing a bit of outperformance by the technology sector within the S&P 500 since the Rose Garden. Our quant work suggests that value no longer looks deeply undervalued versus growth, and that earnings revisions and forward EPS growth expectations are still a bit better in growth than value. With consensus GDP forecasts coming down, expectations for sluggish growth to recession are settling in among the economics community, and those headwinds could be more of a pressure on earnings growth for the value cohort than the growth cohort. The big problem for growth that we see at the moment is that when we were seeing evidence of rotation from the U.S. to Europe within global equities within the EPFR flow data, big cap growth stocks were getting hit very, very hard. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.